On Monday, a new U.S. banking rule begins to hit the real world, not because it's flashy, but because it changes incentives inside the largest banks. There was no countdown on TV, no big headline. But the timeline is real, and the effects show up the same way they always do, in liquidity, in volatility, and in what banks choose to hold or avoid. Before we do anything else, I'm going to show you the receipts, because this video is not about rumors. The Federal Reserve, along with the FDIC and the OCC, issued a final rule that modifies certain leverage capital standards for the largest and most systemically important banking organizations. The Federal Reserve's official release states, the final rule takes effect April 1st, 2026, and banking organizations may elect to adopt the modified standards beginning January 1st, 2026. That's the official timeline. That's not a creator interpretation. It's the agency language. And if you want the deeper why, the Federal Reserve and OIS supporting memo explains the intent in plain terms. The leverage standard is supposed to be a backstop to risk-based capital rules, but the agencies observe that supplementary leverage ratio requirements were often becoming a binding constraint. When that happens, banks can be disincentivized from lower risk, lower return activities, including intermediating in the U.S. Treasury market. This final rule is designed to reduce that friction and realign incentives. The memo also repeats the timing, effective April 1st in 2026, with early adoption permitted beginning January 1st, 2026. Now here, to us, the part most people miss, you don't need banks to fail for markets to move. Markets move when incentives shift, and a leverage rule is one of the cleanest incentive levers regulators have, because leverage rules don't care whether an asset is marketed as safe, smart, or popular. They care about exposure and required capital. So what changes for you, the average American who's not sitting on a trading desk? The answer is not panic. The answer is pay attention to liquidity behavior. Liquidity is the hidden engine behind what feels like random spikes, sudden sell-offs, weird rallies, and unstable price action. When banks face new constraints or new relief, they adjust. And those adjustments can show up first in places that are crowded, leveraged, or reliant on smooth market plumbing. Here's the simplest way to think about it. Imagine a warehouse where every box takes the same amount of shelf space no matter what's inside. If management raises the cost of shelf space, the warehouse doesn't collapse, it reorganizes, it becomes selective, it stops storing low-margin items, it prioritizes what keeps the business stable. Banking regulation works the same way. If the cost of holding something changes, behavior changes. Now I'll give you 3 scenarios for what can happen next. These are not predictions, they're scenario paths, because markets are probability machines, not certainty machines. Scenario 1 is the boring one, smooth transition. The biggest banks are prepared, most changes are absorbed quietly, and you don't see dramatic headlines. In this scenario, the impact is gradual. Small shifts in spreads, calmer functioning in some corners, and nothing that looks like a crisis. If you're a long-term saver, this is the scenario where you mostly ignore the noise and stick to your plan. Scenario 2 is where people start feeling it, a localized liquidity squeeze. Even a stability rule can cause short-term repositioning. If desks have to rebalance exposure, they often sell what's easiest first or step away from the least rewarding activity. That doesn't mean the system is breaking. It means the hallway got crowded and a bottleneck formed. What it looks like in the real world is not one clean crash. It has jumpy price action, wider spreads in specific areas, and sudden intraday whipsaws that feel irrational unless you understand liquidity. Scenario 3 is the most viral and the most dangerous, headline shock. This is where the market reaction is driven less by the rule itself and more by the story people tell about the rule. A clip goes viral. A creator says, "It starts now." Fear spreads faster than facts. People front-run each other, and for a few days, the narrative becomes self-fulfilling because everyone is trading the crowd instead of the document. This is where your advantage is staying calm and tracking signals, not emotions. So what should you actually do with this information? Here's a simple checklist you can follow without needing a terminal, without conspiracy thinking, and without making any sudden life decisions. First, anchor yourself to the real timeline. For this specific rule, the official documents state an April 3rd and a 2026 effective date, with an option for early adoption beginning January 4th, 2026. If you see anyone claiming an immediate start date, your first move is to ask, show me the primary source line. Source. Second, watch liquidity behavior, not just price. Price can move on hype. Liquidity changes show up in gaps, weird intraday reversals, and a general fragile feel where small news moves markets too much. Third, watch spreads and volatility behavior. You don't need fancy data to notice when markets stop trading smoothly. When everything feels jumpy at once, that's often liquidity tightening. Fourth, don't let a technical rule force you into forced timing. If you're a long-term investor, your real defense is boring, emergency fund discipline, avoiding high-interest debt, and not making emotional all-in moves based on one scary story. Fifth, keep one personal rule written down. I don't change my entire plan because of one headline. I change my plan only when the facts persist and the trend confirms. Let me summarize this in one sentence. This is a real, finalized U.S. banking rule with a clearly stated timeline, designed to modify leverage standards so they function more as a backstop and reduce disincentives for low-risk market intermediation, including in Treasuries. What matters for markets is not drama. What matters is how incentives change liquidity and how liquidity changes price behavior. This video is educational and informational only. It is not financial, investment, tax, or legal advice. I'm not a financial advisor. Markets involve risk. Verify claims using primary sources before making decisions.